Friends, in this video for ithought Advisor, I'm going to talk to you on the topic multi-asset investing. Most people used to prefer investing in one single asset class. This asset class would predominantly form a part of their overall portfolio. Historically, it used to be debt, and even within debt, it used to be fixed deposits. But a lot has changed in the last decade, and today we find most investors doing the same thing with equity. So, equity has become the predominant asset class in most investment portfolios. But given the volatile economic circumstances that we live in, the way the world is facing so many macroeconomic challenges, one asset class is certainly not enough to form a stable investment portfolio. So you need a far more balanced investment approach than ever before right now. Also, you need a portfolio to comprise multiple assets with a very diligently thought through asset allocation. Within that asset allocation also, you need choices of instruments done in such a way that there is a very nuanced risk management practiced in every decision. So, given the kind of economic circumstances that we live in, the investment approach needs to be much more nuanced now than ever before. I've seen times when people said, okay, you want to have multi-asset? Just buy a balanced fund. And then people started saying that you don't know when to invest in equity and when to invest in debt. We will do it through dynamic asset allocation. So just one product is enough. But the times have changed, and we are seeing the very same proponents of balanced funds alone and dynamic asset allocation alone now coming around to saying that it is not enough. You need multi-asset investment approach, and you need multi-asset products to serve you. But ithought as a house comes from a very different place. We have always believed that you need to create a portfolio of products which is representative of a multi-asset investment approach. And that is precisely what we have practiced with our investors over the last 12 years. So we come into this space with a 12-year lead over those who are trying to create and scale up and popularize something very fast. Because when you have done something for a long period of time, then you've seen it all. You've seen how it works, how it struggles, how it challenges you, and sometimes where it fails. So in that sense, our multi-asset foray is not new. It's as old as our existence, and we have done several interesting things within each asset class. So I'm going to give you a few examples. One example is within gold. The popular perception while investing in gold is that you need to buy gold in some form or the other. But we nuanced it even in what form your gold allocation should happen. Should it be in SGB? Should it be in gold Bs? Should it be in units of gold mutual funds? And should it be in gold mining funds? So, we constructed a mix of all these things for our clients. And by doing that, we managed the volatility much better. That's one side. We created that extra opportunity to make returns when gold became the preferred asset class. So, the purpose of holding a multi-asset strategy and holding one asset as part of that strategy is to ensure that when that asset class comes into favor, you're going to benefit more than what others usually do. So, multi-asset class is just not about owning different asset classes just for diversification or just for presence, but using every asset class, participating in it when it is out of favor, and making sure that that asset class has the capacity to deliver superior returns when it comes into favor. What does this actually help to an investor? Now that's something you need to understand very clearly. I'll give you one more example so that it's easy to understand. Let's say we are not too bullish on higher risk equity assets today, like we are not too bullish on small cap funds, we are not bullish on mid cap funds. But you still need to make your equity investments in such a way that you participate enough in equity, you are not under allocated, and yet you have a chance for your equity allocation to give you your targeted returns. How do you do this? You pick up funds and size their positions correctly. Don't make them so big that they become a risk. Price them correctly, position them moderately in your portfolio and size them in such a way that the size doesn't become a risk. Choose different funds. Don't go and buy whatever is popular. Choose that fund when it is out of favor. Doing all this, I'll give you two examples which work very well in recent times. There are several, but I'm just giving you two. One is a public sector mutual fund, a PSU mutual fund, and the other is a bank B. Even by just positioning 5% of these two in a portfolio, we are able to raise the returns of the portfolio significantly, because there are other investments which are part of the equity allocation which do the normal equity return job, which give you decent returns. But where you create those nuanced positions, they contribute significantly higher to your overall returns. What I gave is a very recent example, and it is possible in every market context to create investment positions like that, which make your equity component of the multi-asset portfolio far more resilient and also rewarding. At different points, different products have played this role. At one time, it was FMCG fund. At another time, it was IT fund. Another time, it was a pharma fund. Then it was a natural resources fund. Then it was a small cap fund. Then it was a micro cap fund. Sometimes it's a mid cap fund. Sometimes it's even a large cap fund. At times, it's even a Bharat 22 ETF or a CPSE ETF. So there is no stereotype of which product can give your portfolio that extra alpha. But it's a given that in a multi-asset strategy, such nuance is needed to deliver superior returns. After doing this for 12 years, we have now productized this whole work into a PMS, and that PMS is Spear PMS. I invite you to participate in one of the upcoming webinars on Spear to understand how a multi-asset strategy like this is way superior to your general experience of having a relationship manager who randomly gives you recommendations, and then you make some choices, you miss out some choices, and an approach which is more something which is not strategic is what is generally practiced. You can compare this approach with that approach and then decide for yourself if having all your investment options, your world of investments in one place with Spear PMS is good for you. Thank you for watching this video and thank you for all your support.